Stay tuned because in the rest of the video, I'm going to show you an example of a property that's purchased using a 1031 like-kind exchange side by side with a property that's purchased without using a 1031 like-kind exchange. And I want you to tell me which route you'd rather go. Let's get in unit 734. Now guys, check this unit out. I mean, I like it. Look at that flooring, flat screen TV, nice furniture. I enjoy that tile floor. Paint is nice. Closet here. Wait till you see these quartz countertops. Nice stainless steel appliances. Beautiful cabinetry. I mean, it is stunning. Nice backsplash. Flat top right here, stove. Again, that jet tub, shower. Of course, you do have your nice quartz, as you can see here. It gets even better. Look at this. Modern, trendy, gorgeous. Look at that. Nice quartz desk, recessed lighting. Again, great furniture, plenty of space in here, doesn't feel cramped. Flat screen, you got your fireplace, and you've got your moneymaker right here, guys. This is that ocean front view that everyone's interested in. That balcony. Look at that. Really nice, very well done. You have an additional closet here, as you can see. I mean, this unit, in my opinion, is superb. Now keep in mind that you can always sell that property doing the 1031 like-kind exchange and then invest your money in 2 or 3 or any number of properties. Let's say you wanted to buy smaller units. You found out that you'd rather play the efficiency game than the 2-bedroom or 4-bedroom game. Well, then you can always purchase any number of properties so long as you don't exceed up to 200% of the relinquished property's value. Let's get into 1031 like-kind exchanges. Now, if you plan on staying in the Myrtle Beach oceanfront condo investing game, this could be particularly useful because there are not nearly as many luxury properties in our market. So if you keep increasing the value of your property every time you do a 1031 like-kind exchange and maxing it out, you might end up playing a game where you're owning $1 million properties and it's just not as advantageous for you. So again, that has to be assessed based on your own personal financial objectives, what game you really want to play. Now, also there is the advantage of diversifying into smaller units and diversifying that money up into efficiencies and one bedrooms and things like that. That might also be advantageous for you. For more information on that, you should check out our other video where we talk through efficiency units and diversifying your investment into multiple smaller units. Now I'm just about to jump into another investment plan for you, but first I want to take a deeper dive into 1031 like-kind exchanges. 1031 like-kind exchanges allow you to defer your capital gains tax. Now, this is named after Section 1031 of the Internal Revenue Code. We're definitely going to advise you to get in contact with your CPA or your attorney to dive deeper into the specifics of this. So ultimately, when you sell your property and reinvest the funds, basically you can defer your capital gain tax. It's super valuable, and I'm going to show you a really cool example of the difference between a property being sold, an investment property that's sold not inside of a 1031 like-kind exchange, and then one that is sold in a 1031 like-kind exchange. And you can see that there is as much as a $225,000 difference in those two different processes and outcomes. All right, so how does a 1031 like-kind exchange work? Well, the first step is you have to sell a property. Now, when you sell the property, you're obviously going to realize a gain, and that's step one. It's that simple, that easy. Oh, and just so that you know, whenever you do sell that property is then referred to as the relinquished property. All right, so then you come into the identification period. Now, in the identification period, essentially, you've got 45 days after selling that relinquished property to identify in writing through a qualified intermediary, basically who facilitates the exchange, other properties or a property of greater or equal value. Now, you can identify any number of properties that you want to, so long as it doesn't exceed 200% of the relinquished property's value. Then you enter the exchange period. Now guys, after you've identified the replacement properties, you have 180 days to acquire one or more of the replacement properties that you've identified. Now then you're going to come into the phase where you're going to purchase the replacement property. You're going to use the proceeds from the sale of the relinquished property and the help of a qualified intermediary to purchase the new property. And now finally, you've come into tax deferral. Now, by completing the exchange this way, you are going to defer the capital gains that you would have had to pay on the sale of the relinquished property. Now, the tax liability is going to be deferred until the investor sells the replacement property without reinvesting the proceeds into another like-kind property. Now, here's a few important notes on 1031 like-kind exchanges, a few key points I didn't want you to miss. They've got to be like-kind. They've got to have a similar class, a similar nature, a similar character, regardless of quality or grade. So as long as you have a like-kind property that you've actually identified, you should be good to go. Now, in order to qualify with the IRS regulations, you have to have a qualified intermediary. This person is going to hold the proceeds from the sale of the relinquished property, and then they're going to turn around and purchase the new property, the property that you've identified. They're going to purchase that with those proceeds. Now, strict limits apply to the exchange and identification periods, guys. You cannot miss these deadlines, these time limits. If you do, it can result in the immediate recognition of capital gains. Now, the replacement property must be of equal or greater value in order to fully defer your taxes. If the replacement property is of lesser value, then you are going to owe taxes on the difference. All right, now 1031 like-kind exchanges are really not for personal use properties. These are not going to be for primary residences or vacation homes. So how you purchase the property is going to be very important. You're going to have to purchase the property as an investment property, which means you are going to have to pay a higher interest rate on it, and you're going to have most likely a larger down payment as opposed to buying it as a second home. However, in my opinion, the advantages of deferring capital gains are monumental. So I think it's well worth it to purchase the property as an investment property rather than a second home, so that you can actually do the 1031 like-kind exchange. Now, you'll need to evaluate this information with your own personal financial advisor or your CPA or your attorney, and just make sure that it's going to work well for you. And if you have questions about how to purchase an investment property, in the sense of, do I buy it as an investment property or do I buy it as a second home, please feel free to get in contact with me. I'll be more than happy to help you. Now let's talk through the power of 1031 like-kind exchanges. Guys, it doesn't matter if the property has a loan on it or if you paid for it cash. Using a 1031 is going to give you some great advantages. The money saved in taxes through an exchange can be used to buy more investment properties. I'm going to show you an example of a property that's purchased using a 1031 like-kind exchange side by side with a property that's purchased without using a 1031 like-kind exchange. And I want you to tell me which route you'd rather go. All right, so let's work through this example together, guys. So first, your investor is going to sell a property with no debt for $1 million. Then the property has been fully depreciated and has a basis of $100,000. We're going to assume a combined tax rate of at least 25%. Now that's with federal capital gain, depreciation recapture, net investment, income tax, and state. Now, if you'll look, guys, the outcome by doing the exchange, the investor can postpone paying capital gains tax and acquire a replacement property valued at least $225,000 higher than the investor who sells and reinvests using post-tax funds. It's clear to me that using a 1031 like-kind exchange could be a very advantageous strategy for you. If you have more questions about it, please get in contact with me. Guys, I am so excited to talk to you about this next plan. It's called a HELOC. You've probably heard all about it, home equity line of credit. If you're interested in growing your real estate portfolio quickly and your properties happen to appreciate quickly, then this could be an advantageous strategy for you. And it does happen. I want you to think back through the spreadsheet where I showed you the resellability over the past decade for all the different property types on average in our market, guys. There are some of them that jumped up just in 3 years and 4 years. I have a client who purchased a property at Meridian Plaza who was looking at a property 3, maybe 4 years earlier. It was pre-COVID. He bought the property, and guess what? It was $100,000 more 4 years later. So these properties do jump up in value very quickly. And if that is the case, then you can use a HELOC to take out 85% of the value of that property. Now you tell me why that's advantageous. Because if you're interested in growing your real estate portfolio quickly, you can pull that 85% out and pay down possibly on 2 more oceanfront condos. If you want to learn all about HELOCs, please click the link on the screen now, and let's jump into the next video.